Good afternoon, everyone. My name is Allie Phillips, and for those of you who do not know me, I'm Executive Vice President and Partner here at Obermeyer Wood Investment Counsel. Our team is excited to host you for our March virtual event, the latest in a series of monthly webinars. Spring has arrived, and with vaccines here, just close on their way, we're hopeful that the months ahead will allow for a broader economic reopening, the ability to spend time with friends and loved ones, and a little bit of a return to something resembling normalcy. I know that one thing that we're looking forward to here at our team is the ability to see all of you in person for our regular review meetings or social get-togethers. And while we don't have a timeline for those yet to begin, we are eagerly anticipating the ability to do so more in a few months, and we'll update you when we know more. In the meantime, we do encourage you to schedule some time with us over Zoom or phone. You will be receiving your first quarterly statements in about 2 weeks. If you'd like to discuss this package or anything else that's on your mind, please reach out and schedule some time with our team. And one more thing before we begin. In case you don't know this already, the IRS has announced the tax filing day has been extended 1 month to May 17th, even though first quarter estimates are still due in mid-April. Please reach out to us, our team, if you'd like us to coordinate directly with your tax professional on any missing information or questions they have. Now with that, I'm delighted to have the chance to introduce our guest speaker, Jeffrey Kleintop. Jeffrey is the Senior Vice President and Chief Global Investment Strategist at Charles Schwab. He is responsible for analyzing and discussing international markets, trends, and events to help investors understand their significance and financial implications. Prior to joining Schwab, Jeffrey served as Chief Market Strategist at LPL Financial, and earlier in his career, he was a Chief Investment Strategist at PNC Wealth Management and Senior Investment Strategist at Aris Corporation. He's often cited in the Wall Street Journal as one of Wall Street's best and brightest, and Jeffrey frequently appears on CNBC, Bloomberg TV, and CNN, and is often quoted in the Wall Street Journal, Barron's, and Financial Times. And even more importantly, he's one of my favorite strategists. I've never missed an opportunity to see him at a conference, and I've been listening to him on podcasts on my dog walks this past year. And so really appreciate his perspective as being able to navigate the global markets. I really want to thank Jeff and the entire team at Schwab for making this happen today, including Kelly and Sergio. Schwab has been a wonderful partner for us for the years and gives us support, resources, and platforms that allows us to really effectively serve our clients. We have a long history with Schwab, and it's one that we really cherish. So with that, Jeff, I'll let you take it away, and thank you again.
You're on mute, Jeff.
You'd think I'd have this figured out by now. I lost my menu from the top of the screen. So, hey, fantastic. Thanks, Allie. Thanks, everyone, for the opportunity to speak with you here today. I was just talking to Brian and, of course, Wally before you all joined and talking about how much this is really my favorite aspect of my job. I love talking to investors about what's going on in the markets, what they're excited about or what they're concerned about, what they want to hear more about. It really helps inform my process. And so I really want to emphasize that Q&A that Brian's going to be monitoring here. I really want to emphasize that. Get your questions in. We'll get to them towards the end. I've probably got about 30 minutes of prepared comments here, some charts and ideas to share with all of you that I think are very important. But there are many things. It's kind of a bull market of things to talk about. So there's many things that I won't be able to cover as deep as you'd like. So nothing's off the table here. Anything you want to talk about, I'm happy to dive into. I'm going to divide my prepared comments into 4 categories. One is, where are we in this move from recession to recovery? We take 2 steps forward and 1 step back, and we keep doing that. So I want to talk a little bit about exactly where we are and where we have yet to go, and why that's very important for the stock market here and the bond market as we look to the remainder of the year. And then I want to talk about what probably the media is most obsessed with is this vaccine rollout and how it's different in different states and countries and regions, but how it's very different when you look at it from an investment perspective. So those that are winning in the race to vaccinate their populations aren't necessarily the winners in the markets, even though it's probably the most important thing as we think about the economic and earnings recovery. So I'll get to that. And then I want to talk about the biggest risk the market's obsessed with lately. and that is the return of inflation, reflation, the combination of the recovery and the stimulus. And right now we've got a lot of demand, and yet supply is somewhat constrained. We've got supply chain stretched to the absolute limit. We've got supplier delivery times the longest in 20 years. We've got a boat blocking the Suez Canal. We've got a lot of problems here in getting stuff on store shelves and stuff to manufacturers. That means prices may go up here in the near term. What does that mean as we start to see some inflation pressures for the first time in, gosh, over a decade? So I want to talk about that. And then finally, probably the most important takeaway from this, the investment takeaways, we are in a new global economic cycle, and that means new leadership in the markets. The old leaders never end up being the leaders in the next cycle. It always changes, goes from value to growth or growth to value, and US to international, international to US. It changes in a number of different important dimensions, and we are at an important turning point now. I've been talking about this for about the past year or so, so it's no longer early, but it's not certainly too late. There are years to go in this transition. It's very important to staying on path to your financial goals. So I'm going to focus on that towards the end before I get to your questions. So let me start first on this recession to recovery and where we are right now in that process. I think the best way to look at it, the simplest way, the way I like to look at it is with the blue line on this chart. This is my desert island piece of economic data. If I'm stuck on a desert island and there's only one piece of economic data I'm allowed to have, and you're probably like me, right? You're on a desert island, you want economic data. I mean, what else is there, right? Sure, you want economic data. This is the one piece you would want to have. It's the composite leading index from the OECD. What's that? It's the Organization for Economic Cooperation and Development. And this is the leading index for the entire world. So it captures all the economies in the world, about 46 different economies, and really measures how they're doing. When this index is above 100, they're doing well. Global economy is expanding, it's growing faster. When it's below 100, it's slowing down and it's weaker than average. But when it drops below 99 is when I really start to pay attention to it, because to me, that's the threshold that matters. We've never dropped below 99 and not entered into one of those gray columns, which are recessions, right? Periods where the global economy, including the US, is shrinking and losing jobs, earnings are falling, and stocks have fallen anywhere from 20 to as much as 50%. So bad times, to say the least. And we've had this. Our eyes are naturally drawn to the end of this chart. We've had this incredible decline, the deepest decline in this indicator in 50 years, and an equally sharp rebound. And this is the V-shaped recovery that the stock market has really gotten so excited about. Incredibly rapid turnaround in the global economy, something we've never seen before. And for obvious reasons we could get into, we don't need to. It's been a very sharp drop and then sudden turn back around again. But while we're above 99 and kind of emerged from recession, we're not yet at 100. We're not above 100 where the economy is doing well and growing at an above average pace and really feeling like it's on solid footing. We're still below that. We're still in that 99 to 100 range where things are still a little weak, still a little vulnerable. In fact, we're back to where we were in late 2019. Now, back in 2019, late 2019, I was talking about in my 2020 outlook how we were vulnerable to a recession. I mean, I didn't see a global pandemic coming, but I was worried about trade policy and a lot of other factors that given the backdrop of a very vulnerable and weak global economy, we could be due for a recession in 2020. I give a long list of reasons why, and this is one of them. And sure enough, we did. But the key message is that we're only back to where we were then. And it wasn't that difficult a prediction. Back in late 2019, 6 of the major world economies were already at zero or negative GDP. They were already on the threshold of recession. I'm talking about Canada, the United Kingdom, Japan, Germany, France, Italy. They all had zero or negative GDP in the fourth quarter of 2019, pre-pandemic. So it wouldn't have taken much to push them into a recession, but of course it was a very big push. But the point is we're only back to there. And the US economy was growing pretty sluggishly at that time as well. And S&P 500 profits here in the US were falling on a year-over-year basis. So we're only back to there. Well, it feels like we've come a long way back. We've still got a long way to go. And that's obvious on Main Street. but it's a little less obvious on Wall Street, where stocks have rocketed back. And that's why I think stocks have been moving a little more sideways this year, kind of waiting for the economy to kind of get above this 100 level, maybe in the second half of this year into a self-sustaining recovery, and then really have a lot more confidence in that earnings and economic rebound. At the present time, we're still in that sort of soft spot we were back in late 2019. But let me zoom in and show you exactly what that's looked like over the past year. This is what it looks like, a bunch of spaghetti, I know, but this is for 6 countries, what the daily economic data has looked like. Now, to be honest with you, there really isn't any daily economic data. There's only monthly, quarterly, occasionally weekly economic statistics. But if we want to look at what's happening on a real-time basis, we've got to get creative. So what I've put together here are indicators that look at daily indicators of economic activity, things like subway ridership, which we can get. We can also get things like air pollution, which is a good proxy for manufacturing activity in different parts of the US and different parts of the world. So indicators like that we can get daily that may give us a sense of what the economy is doing at that moment in time. And obviously you can see back in February, March of last year, the huge plunge in the economic output of these countries as everything got shut down to try and prevent the spread of COVID. And then the equally rapid rebound, that V-shaped recovery in May, June, July, as much of the economy came back. Not all of it. Travel, entertainment, services, experiences were still shut down. You couldn't go to the theater, or airlines weren't doing too well, or hotels, restaurants. We all know this. And that's why things flatlined through the summer after manufacturing rebounded. And then we got to October. I should say more like November. We got good news on the vaccines, but we got bad news on variants. And that led to a second round of lockdowns in some states and some countries. And so you can see what happened to the data. Now, fortunately, those have been successful. And now we've started pretty slow start to the rollout of the vaccination programs in a number of countries, faster in others, but we've started to see some economic improvement there. But still, not even back to where we were at the start of 2020. So we've still got a ways to go. So much is dependent on that continued mass vaccination program rolling out, kind of getting to a 50% threshold by the middle of this year, such that we can really open the rest of the economy in the second half of this year. Much of the stock market's gains from here on out are dependent upon that V-plus shaped recovery in the economy. Now, the data that's been coming in has been better than expected. I mean, even though the data is not strong in a traditional sense, it's been better than expected. This is an economic surprise index, meaning it measures whether the data is surprising on the upside or the downside. And this matters to the stock market. Stocks often react to whether data is better or worse, not good or bad, right? You could have a really miserable economy, but starting to get better, and the stock market really reacts positively to that. And that's what we're seeing here. The data is still pretty soft, but better than expected. All of these indicators are above zero, which means the data over the last 30 to 90 days has been better than expected. And the degree to which it's above zero measures how much. And Europe, believe it or not, given its slow vaccine rollout and all kinds of other problems in the aftermath of Brexit, is actually seeing its data exceed expectations even more so than in the US or Japan. And that partially explains why the European stock market is the best performing of anywhere in the world this year. Interesting takeaway from the slow vaccine rollout, but we are seeing a better performance there, and this economic rebound being better than expected. And that better than economists have expected data is turning into better than analysts expected data when it comes to earnings. Earnings are the key driver of the stock market. Nothing more important than earnings over time. And here, as we look to 2021, we're seeing a very strong rebound expected by analysts. And these numbers are going up every day. In fact, we're headed towards the Q1 earnings season here in a few weeks. And I imagine, once again, companies will likely surprise analysts with how strong their numbers are. In the US, we're expecting 24% earnings growth this year. That's the consensus of Wall Street analysts. But gosh, the numbers are even higher than that outside the US. Look, Eurozone, EM, Canada, the UK, EM stands for emerging markets, primarily China, Korea, and the like. Incredible numbers, 30 to 40% gains in earnings, primarily because the companies that make up those indexes are more economically sensitive. They've got more in energy and materials and financials and industrials, businesses that make things, as opposed to the US has a lot of exposure to tech and healthcare, which is more tied to services. So much more of an an earnings and economic rebound outside the US this year for the first time in many years. We're seeing that kind of momentum. And again, surprisingly strong momentum helping to lead international markets to outperform here in 2021. So that's the backdrop. Now, before I wrap up this section on recession to recovery, I want to explain why these earnings are so strong when we still feel like the economy is still kind of limping along. And it's true, and it is. But let me explain. First, stocks are looking forward, right, to the recovery throughout this year. And the fact that stocks are far more keyed into manufacturing than the overall economy is. Manufacturing makes up almost half of the businesses in the stock market, and manufacturing is booming. We haven't been spending as much on experiences lately or travel. We're spending a lot more on computers and phones and Pelotons and all these things we can do from home. And that's really been booming, and it's really helped the stock market. But take a look at its share of the global economy. Manufacturing is only 17% of the global economy and only 11% of the US economy. So it's not been enough to offset weakness elsewhere. And that's why the job recovery is really relatively lackluster compared to what we're seeing in terms of earnings, because we just haven't seen that strength reflected in the rest of the economy. I think in the second half of this year, as we see, the service sector begin to reopen again, that will turn around. We'll see that strength we're seeing in manufacturing be sustained, but I think accompanied by strength in the gray portions of these charts and a broader recovery. It'll feel better on Main Street and sort of catch up to what we're seeing on Wall Street. Hope that makes sense. It's not that Wall Street's not connected to Main Street, disconnected in a different reality. It's that they're connected differently, much more exposure to manufacturing. Sometimes that's good, like the past year. Sometimes it's bad, like in 2019 during the trade war, when manufacturing was very weak and the service sector was actually pretty strong. The economy was doing a lot better than earnings at that time. Now it's the opposite. So that's where we are. A lot depends on the recovery in the second half of the year based on this mass immunization. So if lots depends on that, where are we in that process? Now, I'm sure you can look every day in the New York Times or watch the news and get a sense of where we are in the vaccine rollout in your city, in your country, in your state. But let me give you the big picture, the way I think the market is looking at this. This is my favorite way of looking at it, which is just what percent of the population in different countries has had at least one shot since they started giving shots. Now, the UK was the first to start immunizations, and they're still in the lead, and they've been pretty impressive in their rollout. After a slow start in the first 30 days, really ramped it up and are near 50% of the population having received at least one shot. Same thing's true for the US, tracking a little bit behind the UK, but only barely, really doing a pretty impressive job, although varies dramatically by state, pretty impressive job overall in getting the population vaccinated, and certainly to 50% within the second quarter, which is kind of what the stock market sort of benchmarking. But take a look at Europe, the European Union, pretty slow, lagging by a lot. And China, lagging even more so. So this seems, given how important it is, seems like an obvious takeaway for investors, right? I mean, we should be investing in the US and the UK and really avoiding Europe and getting very much away from China. But here's the thing, it's the exact opposite in the stock market. Europe and China have actually been the best performing markets in the world. This is from a few days ago, and markets have pulled back a little bit here over the last week, but the relative performance is the same. Europe is doing great. The UK is actually the worst performer now, and the US is just a little bit better. So we're seeing the opposite take shape in the markets. Why? If this is the most important thing to the economic and earnings recovery, and that's important to the stock market, what's with the disconnect? I think the disconnect comes down to a couple of things. Number one is that vaccinations aren't everything. China's done an amazing job since their initial cover-up of keeping control of the virus using traditional means. If there's a breakout in a city, they shut down that city, test everyone, quarantine anyone who tests positive, and I'm talking about millions of people, and then the rest go about their business a few days later. And it's really done an amazing job in keeping the numbers down, but at the same time, hasn't created much of an incentive for people to get vaccinated. So the economy is actually doing really well. China's economy is the strongest in the world right now, and has been for months, all the way through to the consumer, even to the point where China has seen the strongest box office numbers of any country in the world in any month ever in February. Incredible numbers. People were going to the movie theater in China, people gathering together for entertainment in an enclosed space without having been vaccinated. Just a clear sign that they're not worried. They feel like they've got a handle on this, and their economy is wide open and booming as a result. That's why China's stock market has done well, not because not because of this slow rollout of vaccinations, but because they haven't needed the vaccinations. They'll get there, but at a slower rate. It's not slowing their economy down. Now, in terms of the UK, the other end of the spectrum, they're doing such a great job. Why aren't they out in front? Well, take a look at the revenues of companies in the UK and where they come from. Only about 20%, 23 to be exact, of the revenues of companies in the UK come from the UK. Only 20% of the revenues are sourced domestically. So while the rollout of a vaccine in the UK is nice, 80% of the revenues are dependent upon that rollout elsewhere, including the US, China, and other parts of the world. So the real message here is it's about the entire world getting on this path of recovery one way or another and reopening in the second half of this year, rather than this sort of winners in one country versus another. It's just not shaping up that way in the stock market. So I want to make that clear, because it can seem like an obvious takeaway from the relentless news reports on all of this, who's winning and who's losing. And the difference is much more nuanced than that in the markets. It's never that easy in the markets. The overall path, however, is important. And I want to point out that Europe, I'm going to go back 3 slides. Europe, which has not been keeping up at all, is about to really ramp up sharply in the second quarter. The big issue in Europe in the first quarter was supply. There just wasn't supply. They didn't order enough, and they didn't order early enough of the 3 major vaccines. They have been more aggressive in the J&J vaccine. That's the one-shot vaccine that was just recently approved. In the second quarter, they're right now at about 6% of their population having received 2 doses, so fully vaccinated. By the end of the second quarter, they should be over 50%, about 60%. So a 10 times increase in the speed of vaccination in Q2 versus Q1, given the rollouts. And we can see those rollouts and the orders that have been placed and what should be fulfilled through the manufacturing channels. So a lot of major vaccine manufacturers are in Europe. They're producing for Europe, and they're coming online. Even some that don't have a vaccine candidate, like Merck, are going to be manufacturing other pharma companies' solutions. So that should really ramp up pretty dramatically and get them to about 50% threshold by mid-year, which again is what the stock market has in mind, that if your economy is not fully open yet, you've got to get that open, and the threshold is somewhere around 50%. So I don't want to belabor this too much. It is the most important issue. Yes, there'll be some stumbles. There have been some stumbles, but as long as we're tracking towards those kind of numbers, I think overall the markets will do well, rewarding more cyclical parts of the market. Again, like financials and industrials, more value-oriented areas. Now, let me move on to this reflation risk, because this is what's really caused the market to move forward and then move back this year. I mean, it's great that we're in a recovery and there's lots of stimulus, but what if that causes inflation? And that means the Fed has to hike interest rates before they might otherwise. Isn't that bad? And the market's kind of moved up and down this year. It's feeling like less of a bull market this year and more of a bunny market this year. Okay, it's not a bear market either. It's more of this hopping up and down we've seen so far. And yesterday we had this kind of back down, up a little bit later today, but it's kind of bouncing around, feels a little different. And, I think that may continue a little bit longer here until we feel like we're past this period where it's this push and pull between the data and the stimulus, and then concerns about what the Fed might do. We have seen a big rise in interest rates, and that has begun to affect the stock market. And I want to focus on that, because I think it's really those days where we see a sharp rise in interest rates that the bunny has felt the need to hop back down again. Here's what this looks like. So the blue line year to date is where the 10-year Treasury bond yield has gone. So generally, when we talk about interest rates, we're always going to refer to the 10-year Treasury yield. And that's gone up quite a bit from about 90 basis points at the start of this year, 0.9%, to about 1.6. It's even about 1.7 more recently. This chart's about, what is that? About a couple of weeks old at this point. But you can see it's really surged up, but the relationship has remained intact. Stocks did move in sync with interest rates because rates were going up because growth was looking better. And when real growth and inflation is stronger, that's usually good news for the stock market, particularly in this case, emerging market stocks, which are the most sensitive to interest rates. But once we hit 1.3%, that all changed. And stocks, led by emerging markets, but certainly in the US and Europe, everywhere, began to head lower as rates broke out over 1.3%. And that persists to this day. Whenever we have, a big rise in rates, stocks tend to pull back, especially emerging markets. But I want to point out that this is really unusual, and I don't think this is going to last. If anything, I think it's a buying opportunity on this weakness in the stock market as the bunny hops back down when interest rates have hopped higher. Because here's the thing, I'm going to give you 3 reasons why I think this is not something to be overly concerned about. I think interest rates are going to continue to rise over the course of this year. Our chief fixed income strategist, Kathy Jones, believes rates could push as high as 2% later this year on the 10-year Treasury. I think stocks can climb right in line with that further move higher in interest rates for 3 reasons. Number 1, it's normal. It's typical for interest rates and stocks to rise together. In fact, looking at emerging market stocks, the most interest rate sensitive part of the stock market, we've had an interest rate rise of around 1% or so over 200 days, 8 times over the last 10 years or so. 7 of those 8 times, stocks were up right along with interest rates, sometimes double-digit gains. Only once, 1 out of 8 times was it down. That was in 2013. They fell 1%. Rates really shot up during that period of time. We call it the taper tantrum. That was back when the Fed began to give some signals that they were going to stop, maybe begin to slow their stimulus, start to slow the buying in the bond market. And the thought was, well, they were going to quickly go from tapering their purchases to tightening monetary policy. As soon as they were done tapering, they were going to hike interest rates. Well, that didn't turn out to be the case for 3 years. So the market got ahead of itself in anticipating the Fed was going to turn around and get very aggressive. I think this time the market recognizes, as confirmed by the Fed this week and last week in communications from Chairman Powell, they have no intention of getting aggressive anytime soon. Happy to let inflation run above trend for a while before they even consider that. Most members of the Fed right now are thinking 2024 is probably the earliest that they would hike interest rates a long time from now. So I don't think we're in that 2013 scenario at all. And I think it's normal for interest rates to rise right along with the stock market. Second, interest rates aren't the only thing going up. Commodity prices have really surged as well. This is a chart of raw industrial prices, so things like copper and cotton and iron ore and the like. And you've seen just a huge spike here. Now, I'll just highlight, because this is, I'm focused a little bit on emerging market stocks because they were the most sensitive to the rise in rates. Many companies in the emerging markets make commodities. They're in Latin America or Africa or Eastern Europe or the Middle East. And they're very tied to commodity prices. So their revenues are shooting up even faster than their interest cost is. And that wasn't the case back in 2013. Look back then, commodity prices weren't going up at all. So even though their debt costs were going up, they weren't seeing it on the revenue side. Huge offset this time. Commodity prices are going up even faster than interest rates. So that's an important offset. And third, there's no worsening of financial conditions in emerging markets or really anywhere. What do I mean by financial conditions? I mean, really just the ability to borrow. Banks are as willing to make loans as they've ever been. And the conditions for those in terms of down payments or collateral or whatever, it's as easy as it's been. So what we can see in this indicator is when it spikes, that's bad news, right? As it spiked in 2008 and 2009 and spiked during the recent recession tied to the pandemic. But the level's back down to normal. We're not seeing any kind of pressures at all. all that improvement over the last 10 months is still intact. So it's not hard to borrow for small companies in the US, in Europe, or even in emerging markets, which is sometimes the case when interest rates spike up and signal some kind of concern. So for those three reasons, among others I could mention, I think when the stock market's pulling back on concerns about rising interest rates and inflation, it's more of a buying opportunity than a threat, at least in the near term. This could build into a threat longer term, maybe a few years from now. But right now, I think investors are premature in worrying about the threat of reflation. Okay, now let me turn it to these investment takeaways before I get to your questions in a couple of minutes. Main point I want to make from an investment perspective, I've hinted at this, that international markets seem to be looking pretty good for the first time in a long time. I think there's a whole generation of investors who can't remember when international markets outperform US markets. And I sympathize, but the tide has started to turn. We are in a new cycle and we're getting new leadership. In order to describe this environment we're in, I have to show you this chart. And if you've ever seen me present before, then you've seen this chart before. I've been using it for over 20 years. I learned about this relationship in college and I've used it ever since. The dark line on this chart is what we refer to as the yield curve. It's the difference between long-term and short-term interest rates. It's one minus the other. Usually long-term rates are higher than short-term rates, right? A 30-year mortgage rate is usually higher than a 3-month CD, but not always. Sometimes long-term rates drop below short-term rates. It's a signal of an imbalance in the economy where there's not a lot of long-term investment happening, but things are heating up in the short term. And that whenever that's happened and that's turned negative, I've marked it with an orange dot on this chart. You can see there's 7 orange dots. After every one of those orange dots, about a year later, we get one of those gray columns, which is, as we know from the first chart, a global recession, where the US and the rest of the world falls into a downturn and stocks fall anywhere from 20 to 50%. Now, I pointed this out back in my 2020 Outlook published back at the end of 2019, but I wasn't saying, oh my gosh, watch out for a recession and bear market. What I said was, because they can be over very quickly, what I said was watch out for the rotation. Watch out for new leadership. Often when we go through these periods of upheaval, investors want to hold on to the old winners, believing they'll be the first ones to come back, but they never are. Whenever we start a new cycle, it's new leadership that takes root in the markets. Let me show you what this looks like. So this is a chart of the relative performance of US and international stock markets. When the blue line's going up, international stocks are outperforming. And when the orange line's going up, US stocks are outperforming. They're just mirror images of each other, but I put them both on there to show you the gaps. Back in the 1980s, the beginning of this chart, it was all about investing overseas. Japan had the biggest stock market in the world and it was booming. And it really outperformed US markets until we got to that blue column. Now, this isn't gray. It's not a recession. It's that orange dot. It's that period of yield curve inversion just before the gray column. So the gray column just followed it. In 1989, we got an inversion of the yield curve, signaling the recession of 1990. But that yield curve inversion signaled a shift in relative performance, that new leadership was coming into the markets. And sure enough, international stocks began to underperform. In the 90s, it was all about US stock market outperformance, led by the tech sector, until 2000. The next yield curve inversion, which led to a recession in 2001, and international stocks came back and led the way until 2007. And the next yield curve inversion, and of course, recession in 08 and 09, flipped the switch back to US outperformance. And over the 2010s, the US stock market outperformed international stocks to the same degree international outperformed the US in the 80s. But now, at the start of a new cycle. I would say the last one ended maybe in April. Well, we're not fully out of it yet, but that's when the economic data bottomed in April of last year. And since then, we've started to see international stocks outperform. No surprise, because this has happened every single cycle for 50 years. It flip-flops between the US and international. And it does this because of fundamental and behavioral reasons. After a full cycle of outperformance, whatever's been outperforming, it's stretched. It's stretched in terms of valuations and expectations, and the recession resets those expectations. And whatever lagged begins to outperform. Now, this is a little complicated, and it is. Let me just show you what it looks like in a chart, looking at the periods between those gray columns. between the recessions in 81 and 1990, international stocks outperformed in the 80s, led by Japan, by 6% per year. Then in the 1990s, US stocks outperformed by 9% per year. In the 2000s, flipped the switch back to international, 6% per year. And of course, the 2010s, 6% per year for the US. That's a big difference. Notice there were no negative returns here. It wasn't that, when international was outperforming in the 80s, that US stocks did poorly and fell. They didn't. They just didn't keep up. They didn't do as well. So getting this right is important. Having, rebalancing your portfolio, making sure you have exposure is really important as we go through these, because a 6% differential is absolutely critical to staying on the path to long-term financial goals. Now, what's happened since the end of this chart? What's happened in the start of this next cycle? We see the 6% gap of relative performance, and that's exactly what's happened since April of last year. The blue line, international stocks, the ACWI index, that's all country world index, literally every stock in the world, excluding the US, that's up 37%, US stocks up 32%. So a 5% difference. I think as we get to April 30th, wouldn't surprise me to see an exact 6 percentage point difference. US stocks haven't done poorly. They've done great, but international stocks have done a little bit better. And by the way, this doesn't just work between US and international, it works between growth and value as well. Value stocks coming back and outperforming growth stocks. Financials outperforming technology, right? So we're seeing this rotation from the laggards to the leaders. It's not just a 6-month or a 1-year phenomenon. This is likely to persist this entire cycle of 5, maybe 10 years. And it's something many individual investors who don't have the benefit of the guidance of Obermeyer Wood, who are on their own, they miss this. And it usually takes years for them to realize that things have shifted. If you're not rebalancing and in a disciplined asset allocation, you can miss these shifts. And so I really talk about this a lot to individual investors to make sure they don't get on the wrong side of this, because it can really set you off and get you away from your goals. So anyway, let me sum this up, and then Brian, we can get to those questions. Number one, full recovery, I think, is likely this year after mass immunization. The second half of this year will open up the rest of the economy, leading to those very solid earnings gains that are probably even underestimated in the very strong numbers I showed you. The vaccine rollout winners are not market winners, so don't get too caught up in what it means to be rolling out these vaccines. It's the global vaccination program that's most important to these globally dispersed businesses. And reflation, premature to worry about that. I think for the next year or two, interest rates can go up right along with the stock market. And then finally, it's a new cycle, look to new leadership. So let me finish up there and just see what questions have come in. What do you want to talk about, maybe some more, or what topics maybe that I didn't touch on?
Sure, great. Thank you very much. And then folks, just a reminder to please submit your questions using the chat box at the bottom of the screen, and I will go ahead and read them out loud. So Jeff, the first question goes back to vaccines, specifically in the EU. And so the question is the EU vaccination rate relatively homogeneous across the EU, or are some countries higher while others are lower?
That's a really good question. The European Union chose to purchase vaccines on a collective basis. So every one of the members of the European Union is subscribed in one big chunk of orders. And then those orders are disseminated on a per capita basis per country. So they are all experiencing the exact same rollout. I mean, some have been a little bit more effective in getting their populations to take it, more effective in delivery. But everybody's getting the same allocation of supply. And so their rollout has been pretty consistent.
Right. Next question. What do you think of Jeremy Grantham's concern that we're in a bubble?
I think there are some little bubbles to think about. I think that there are areas of the market where investors have really just fallen in love. And that always happens from time to time. Fortunately, none of those areas are large enough, I think, to take down the whole market. I don't think we're seeing a bubble that's of the significance of the housing bubble. Personal assets, for most people, their home is their biggest asset. And when it plunged in 2008 and 2009 and imperiled the financial system. It was a major shock. And it took years for people's wealth and finances to recover. Back in 2000, the stock market took an enormous plunge and took a very long time to come back, took years to come back. This time, there's no, there was no asset damage to people. Many people lost their jobs. Some businesses failed, although a lot less than you would think. But the asset damage to home values, no, they went up. Stock market values, they went up. So we're not seeing that kind of lingering damage that would cause a longer a disconnect in the economy and maybe cause a bubble to pop. I think where we're seeing some frothy activity, maybe some of the call option activity, some of the retail trading frenzy activity in stocks like GameStop, some of what we're seeing in Bitcoin, for example, and NFTs. I mean, some of that is just enthusiasm and excitement. We're not seeing that broadly, though, across the markets. I'll give you an example. I just tweeted out today. My Twitter handle is @Jeffrey Kleintop if you want to see the chart. The put-call ratio in Europe, which is actually high, meaning it's a fear gauge. There's not over-optimism in Europe. If anything, they're a little worried. In the US, it's the opposite. There's a lot of excitement among investors. So, I think it's all where you look. Jeremy Grantham doesn't have a great track record in calling these things. His long-term forecasts haven't worked out too well, but that doesn't mean I dismiss him entirely. I do think there are some things to focus on longer term. Look, we've got some geopolitical risks. The Biden administration has not de-escalated threats with China. They've escalated them, and that could lead to further trade concerns later this year, particularly around tech or 5G rollouts, and we'll see how that shapes up. There are other concerns. Japan has an election. I think it's June 13th, it might be the 18th, where a hardliner is likely to be elected. That could lead to increasing conflict in the Middle East and could lead to some volatility in oil supplies. Venezuela is an absolute powder keg. That's an issue. North Korea started to launch missiles again. That could flare back up again. So geopolitical concerns are an issue. I mentioned interest rates. There's this other issue with zombie companies right now. Only about half the number of businesses failed last year than would fail in a normal year. It's the worst recession in 50 years, but only half the number of businesses that fail in a normal year failed last year. They're being kept alive on artificial life support. Now that was good because it kept jobs and it kept a lot of businesses from failing that those people wouldn't have found jobs elsewhere, but we can't sustain this forever. These are businesses that would have failed regardless of COVID-19. They ultimately need to be allowed to fail so that new businesses can start. Because if we just pour more stimulus money into these zombies, they're barely able to make their debt payments, barely able to make payroll. They're certainly not going to grow. They're not going to buy a new truck. They're not going to open a new bakery. So it's not a good return on that investment. So that's a concern. Zombie companies are a concern to me. There are a variety of worries that I have around this environment that are unique to this cycle. But I'm not worried about a bubble. I'm just not seeing, yes, there are some smaller bubbles. They're not big enough to affect portions of the economy that would cause a major bear market or double dip recession that would linger for any period of time. Nothing I'm seeing that would cause me to worry about that.
All right, our next question is about energy. So it's a little bit of a long question here, so bear with me. The global energy transition is dramatic and accelerating. Peak oil and fossil fuel use and peak carbon emissions were probably in 2019, but soaring renewables and more efficient use risk stranding trillions of assets on current balance sheets. Do you think the market has priced that in? And how else do you think about this issue?
So let me make sure I understand the question. So the question is about maybe maybe devaluing fossil fuel assets?
Yes.
Yeah. Okay. So here's how I think about that. There's a long period of transition. I know it feels like it's ramping up. Many businesses are ramping up. Many countries have put together very impressive green initiatives. China is a leader in producing electric vehicles. They're still buying a huge number of regular fossil fuel burning cars. I think this transition is going to take some time. And here's the thing. So let's say all of us on the call here, I'm looking at all of you right now. Let's say all of us take Exxon private tomorrow. All right, we're just gonna borrow some money. We're gonna do that. We're gonna take it private. Let's say we were able to sell their proven reserves at half the going price in the market of oil today. So I just did this calculation the other day. That's currently double the market cap of Exxon. So I think the company is being valued on fossil fuel extinction. As a matter of fact, it might be being pessimistically valued on the prospects there. I think if you were to sell those reserves to another player and just say, we're never going to do another penny of exploration. Let me give you an example. So I think of tobacco stocks. When they were suddenly not able to advertise anymore, I mean, there were dinosaurs, right? Who's ever gonna, smoking peaked out. It's clearly going to decline. They can't even advertise anymore. These businesses are poised to, they're going to go out of business, right? The stocks went up 700% after that. Why? Because marketing was expensive. They didn't have to do it anymore. And it took a long time to wean people off smoking. Smoking is continuing to fade, but maybe not as fast as people thought. And those companies were worth a lot more than it seemed. If energy businesses simply stop very expensive exploration and production type activities and just are looked at as a cash cow as they just sell off their proven reserves, those companies could be worth a lot more than they are as going concerns. So I'm not so sure that those stranded assets on balance sheets would imperil an entire sector like the energy sector. I actually think it could be a good thing, and they could pour those resources into, developing better battery technology or what have you. So I'm not a pessimist on, some of these big fossil fuel companies. I think there could be some value there, and we are not underweight the energy sector, although, we certainly are excited about the green wave of technologies and interested in what that brings. That's certainly a mega trend for the next 10 years, but that doesn't necessarily mean those literal dinosaurs go out of extinction or go into extinction that quickly.
All right, and I know there might be a follow-up on that in a minute, but we'll come back to it. You mentioned it briefly before, but can you talk about the latest updates on trade relations with China?
Yeah, they suck. Sorry. They are not great at the present time. China is taking its time on this, knowing that they're not the first thing on Biden's plate. I mean, there's a lot going on. China's lucky if they're the seventh thing on Biden's plate right now. But having said that, the Alaska talks were an opportunity to extend an olive branch. There is common ground between what China wants to achieve in terms of better quality rather than quantity of growth. So China is really getting focused on green initiatives. They know their rivers are filthy, their air is horrible, and the people want this now, as opposed to quantity of growth, they want quality of growth. And they're willing to embrace global initiatives on climate control, on climate mitigation issues. And obviously that's a priority of the Biden administration. It was not a priority of the Trump administration, right? I mean, you definitely didn't have that there. Trump's priorities on trade were manufacturing jobs and the trade balance itself. Biden is more labor and environmental standards. And there was room there for at least some cohesive talk. They didn't get anywhere near that. The Biden administration chose to focus on Hong Kong and Xinjiang and demand human rights changes. That is not going to happen. They know that's a dead end. So I think that was a stall for the Biden administration to have a little bit more time to line more allies up on labor and environmental standards issues, to have something to present to China, not vague, but something very specific to present to China that they want them to move on. So in the near term, it's not going anywhere. It's kind of in limbo. None of the tariffs have been rescinded. None of the delistings from the New York Stock Exchange have been relisted. And there may be more delistings to come. So all of that is still pretty high level of friction. Maybe not accelerating at a rapid pace, but certainly not on a trajectory that's improving. I think the second half of this year, well into the summer, before we really see specific policy goals from the Biden administration, then an ability to confront China. China's bracing for this. They've extended talks with their Asian neighbors. They've got talks with South Korea right now. They're working on talks with Japan around a number of issues to try and line up some allies to be able to push back a little bit because they're not exactly sure what Biden's going to come up with in alignment with Europe and Australia and India in applying pressure. So they're trying to line up some allies on their side as well that may back away from any U.S. unilateral policy or multilateral policy shift. So sorry, the point is I don't have a lot to say because we just don't have a lot of substantive action there. Alaska was an opportunity for both sides to extend an olive branch, and they chose not to do so. So that's where we're at. And let me just follow up by saying it's probably more important right now for the U.S. than China. China's economy is booming. Their own domestic consumption is supporting their businesses. They're not really much dependent upon manufacturing exports to the U.S. right now. U.S. is very dependent on exports to China. Remember, even classic American companies like Coca-Cola sells 3 times as many cases of soda to China than they do in the U.S. So it's absolutely critical we continue to keep that market open to U.S. businesses, and so that's more the risk. U.S. businesses need to have a China policy, a China strategy here in the event that the Biden administration doesn't warm things up later this year.
All right, and I would like to leave a little bit of time to come back to some of the other Biden proposals that a few folks have asked about. But really quickly on China, just to follow up, we have an attendee who's just not interested on anything to do with investing in China. What is your view on Chinese stocks?
I would not invest in local Chinese equities, Chinese A shares traded within China. There's relatively little transparency on many of the companies from an accounting perspective. I wouldn't get involved. However, those Chinese shares that are traded in Hong Kong or traded in New York are world-class companies with world-class financial statements. They're audited by international auditors, the same companies that audit all the companies we know here in the US. They have to be to list, and they have to follow SEC rules to list on the New York Stock Exchange and to trade in Hong Kong. So I wouldn't worry about those. Often when you hear about things going crazy in the Chinese stock market, it's literally the domestic market. Stay away from that. That's gambling. It's a casino run by the mafia. But those shares that are listed outside China, that's where you find the Alibabas and the Tencents and really the companies that are dominating global commerce and will continue to over the next 10 years.
All right, and I do want to be mindful of your time, but there have been a few questions about what many of us are expecting to come next week from the Biden administration in terms of a new announcement on an infrastructure and recovery plan. So the first part of the question is what are you looking at in an infrastructure recovery plan itself, and then the revenue raisers, the tax implications that might come along with that.
Yeah, so I'll try and be quick on these. The infrastructure program, remember, this is federal infrastructure. So most infrastructure we think of is at the local and state level. When you think about the road in front of your house as a pothole, that's not federal infrastructure, right? An interstate highway is federal infrastructure. So a lot of the money goes to engineering and construction companies to do the planning. I mean, it's years of planning. There's nothing really shovel ready. Remember all the spending, the shovel ready spending coming out of 2009 and 2010. Well, I mean, that took years to get deployed after it went through all the planning. So that's where the money gets deployed initially. So don't get super excited about that immediately fixing the pothole in front of your yard or seeing local economic stimulus. It takes some time. It does generally improve productivity. We need to see it. God knows our infrastructure is very dated, but that's something that has sort of a slower bleed into the economy. On the second front, how do we pay for all of this? We don't. And the near-term pressure release valve is in the value of the dollar. As we borrow more and more and more, we're requiring the world to hold more dollars, and that's going to put downward pressure on the dollar. At the same time, the Fed's keeping interest rates at zero. As inflation rebounds, that means the inflation adjusted rate of return on cash is negative. So on dollars is negative, that's further pushing down the dollar. So the dollar is the pressure release valve for all the additional financing and stimulus we're doing right now that we have no plans to pay for. And in a 50-50 divided Senate, we're not going to pass the type of the proposals, the campaign proposals that would really result in narrowing that kind of a gap. I mean, maybe you could see some small move on corporate tax rates, but don't expect much change there. I think that's probably something the next Congress, maybe even the next president would have to deal with, because it looks like the midterm elections would probably lead to the Senate shifting back into the hands of the Republicans, just given the seats that are up when it comes to the 2022 election. So I'll just leave it at that. There's not a whole lot to say on that front because I don't think a whole lot's going to happen.
All right. And we had one follow-up question related to China come in while you're answering that one. And that is, how concerned should an investor be in the apparent intention of the Chinese government to interfere with companies in China like Alibaba?
Well, this is, I could do a whole presentation on this particular topic. Remember that when we think about regulation, it's something that happens every day. I mean, wasn't Jack Dorsey in front of Congress today here in the US? So, I mean, we constantly have our executives, dealing with regulators, dealing with Congress as well. So, and they're shifting there and they're having to adapt their business models as well. And we'll have to see what happens in the tech space. And we certainly saw it in financial services. And that's a little bit of what happened with Alibaba and Alipay. And it was just opening up a new area of financial services in China where they really didn't have regulation around all of that. And it surprised a lot of people and they had to backpedal and kind of build regulation and kind of change the rules. That doesn't feel good. It doesn't feel great. It looks like they're making things up as they go and picking winners and picking losers. In some sense, that's true, probably more true in China than it is here, but it happens absolutely everywhere. It just maybe gets a little bit more attention when it happens in China because it feels so authoritative, but in fact, it's happening everywhere. And I think we may feel more of that regulatory and legislative oversight in the coming years here with maybe a more active Congress in this year and next year. So yeah, I mean, it's not great, but I talked to the American Chamber of Business, American Chamber of Commerce in Beijing, in Shenzhen, in lots of, I've got some great contacts there all the time, and they love being there. They love doing business there. They wouldn't want to do business anywhere else. So while the regulations and seemingly arbitrary enforcement from our perspective seems onerous and ridiculous, from their perspective, it's actually getting better and getting clearer and more consistent guidelines. So that's all I can tell you. Just leave it at that.
All right. Well, it is 5 o'clock. So Jeff, I just wanted to thank you. That's all the time we have, but thank you for your time, your insight, and thank you to Charles Schwab and our partners over there as well. So, and of course, thank you to everybody for attending, and we will see you at next month's event. We should be sending out an invite for that in the coming few weeks. And from our entire team, thank you for joining us, and we'll see you again soon.